In a single day, the American stock market lost $14 billion. That's nearly 200 billion in today's money. Gone, vanished, in 6 hours of trading. But this isn't a story about numbers. This is a story about belief, about what happens when an entire nation convinces itself that the laws of gravity no longer apply. The 1920s were intoxicating. For the first time in human history, ordinary people could own automobiles. Electric lights replaced candles. Radios brought the world into living rooms. Women cut their hair short and danced in speakeasies. America had emerged from World War I as the world's richest nation, and it felt unstoppable. Factories churned out refrigerators, vacuum cleaners, washing machines. Consumer culture was born. The future had arrived early, and it was for sale on credit. But nowhere was the optimism more concentrated than on Wall Street. Between 1924 and 1929, stock prices tripled. Not because companies tripled their profits, simply because everyone believed they would keep rising forever. The Dow Jones climbed from 100 to 381 points, month after month, year after year, without correction, without pause. Economists declared a new era. President Calvin Coolidge assured Americans that stocks were cheap at current prices. Even the banker J.P. Morgan said the market was built on a solid foundation. The message was clear. This time is different. Those 4 words. The most dangerous in finance? And so America went all in. Teachers, barbers, factory workers. Farmers who'd never been to New York City bought stocks through their local banks. Housewives invested grocery money. Students skipped classes to check prices. One historian estimated that 1.5 million Americans owned stocks by 1929. In a country of 120 million people, that might not sound like many, but it represented nearly every person with savings to invest. Here's what made it truly dangerous. Most people weren't buying stocks with their own money. They were buying on margin, essentially borrowing money to gamble on rising prices. You could put down just 10% of a stock's value. The other 90%? Borrowed from your broker. If you bought $10,000 worth of stock, you only needed $1,000 of your own cash. And if prices rose 20%, you doubled your money. It was leveraged speculation disguised as investment, and nearly everyone was doing it. By the summer of 1929, Americans had borrowed $8 billion to buy stocks. That was more money than circulated in the entire U.S. economy. The market wasn't built on wealth, it was built on debt. And debt requires one thing to survive: constant growth. In September 1929, a few people started asking questions. Roger Babson, an economist, gave a speech warning that a crash is coming. The market dropped 3% that day, the biggest fall in years. It became known as the Babson break. But Wall Street dismissed him. The dip was called a healthy correction. Prices recovered within days. The belief remained intact, but beneath the surface, reality was catching up. Industrial production had peaked in June. Car sales were slowing. Construction was down. Corporate earnings were flat. Farmers, crushed by debt and falling crop prices, had been in a depression for years. Rural banks were already failing, hundreds of them. The economy was cooling, but stock prices kept climbing, disconnected from the real world. What happens when asset prices rise faster than the value they represent? Eventually, someone notices, and then someone sells. The selling began quietly. Large investors, the smart money, started exiting positions. Nothing dramatic, just a slow, steady retreat. But on margin, there's no such thing as a slow retreat. When stock prices drop, brokers issue margin calls. They demand cash immediately to cover the borrowed portion of your investment. If you can't pay, they sell your stocks automatically, which drives prices down further, which triggers more margin calls, which forces more selling. It's a feedback loop. And once it starts, it accelerates. October 24th, Black Thursday, the selling exploded. 12 million shares traded hands. Phones rang unanswered on the floor of the New York Stock Exchange. Brokers screamed orders. Fortunes evaporated by the minute. Outside, a crowd of thousands gathered on Wall Street, pressing against police barriers, desperate for information. Rumors spread that 11 speculators had committed suicide. It wasn't true, but people believed it, because it felt true. At noon, something extraordinary happened. The most powerful bankers in America, J.P. Morgan, Charles Mitchell, Albert Wiggin, met in secret at Morgan's office. They pooled their money and began buying stocks publicly, trying to stop the panic through sheer force of capital. And briefly, it worked. Prices stabilized. The market closed down only 2%. Newspapers called it a minor scare. President Hoover released a statement. The fundamental business of the country is sound. But confidence, once broken, doesn't repair easily. And the bankers had only delayed the inevitable. October 28th, Black Monday. The selling returned with fury. 9 million shares traded. The Dow fell 13% in a single day, the largest drop in history at that time. Margin calls cascaded. Brokers liquidated accounts without warning. Investors who'd been millionaires at breakfast were bankrupted by dinner. And then came October 29th, Black Tuesday. 16 million shares, more than 3 times the normal volume. There were no buyers, only sellers. Stock tickers, which printed prices on paper tape, fell 4 hours behind. Investors had no idea what their holdings were worth. They just knew they were losing everything. By the closing bell, $30 billion in market value had disappeared. That's the equivalent of $400 billion today, gone in 2 weeks. But the real catastrophe wasn't the stock market. It was what came next. Banks had loaned billions to stock speculators. When the market collapsed, those loans became worthless. Depositors panicked. They rushed to withdraw their savings before banks failed. And because banks only kept a fraction of deposits on hand, the rest was loaned out, they couldn't meet the demand. More than 9,000 banks failed between 1930 and 1933. When a bank failed, your savings disappeared. There was no insurance, no government guarantee, just gone. Money stopped moving. Credit froze. Businesses couldn't get loans. Without loans, they couldn't pay workers. Unemployment exploded. By 1933, 1 in 4 Americans had no job. 15 million people. In cities, breadlines stretched for blocks. In rural areas, families lost farms they'd owned for generations. Communities of homeless people, built from scrap wood and cardboard, sprang up in public parks. They called them Hoovervilles, named mockingly after President Hoover. The collapse wasn't confined to America. Global trade seized up. The Depression spread to Europe, South America, Asia. Entire governments toppled. Extremist movements rose from the desperation. The world economy contracted by 15%. It wouldn't recover for more than a decade. The human cost is harder to measure. Lost dignity, broken families, suicides. A generation marked by scarcity and fear. What began as falling stock prices became a civilizational trauma. So what caused the crash? Excessive speculation? Margin debt? Poor regulation? Economic imbalances? All of these are true, but the deeper answer is simpler and more disturbing. The crash happened because everyone believed it couldn't. Markets are not rational machines. They're collective emotions given numerical form. They run on confidence, on belief, on the assumption that tomorrow will resemble today. When that belief shatters, the system freezes, because money at its core is just a shared agreement, a story we tell ourselves about value. And stories once doubted can collapse overnight. The aftermath of 1929 reshaped the world. Governments created new institutions, the Securities and Exchange Commission, the FDIC, Social Security. Regulations were written, safeguards installed. For decades, the system seemed stable. The lesson had been learned, but here's the uncomfortable truth. The pattern never stopped. The dot-com bubble, the 2008 housing crisis, the COVID market volatility, each followed the same arc. Euphoria, leverage, denial, collapse, different assets, same psychology. Today, global markets are worth over $100 trillion. Algorithms execute millions of trades per second. Information moves at the speed of light, but the system still depends on the oldest, most fragile thing, belief. Belief that the numbers mean something, that tomorrow the dollar will still buy bread, that the institutions will hold. The crash of 1929 taught us that prosperity built on borrowed confidence is not prosperity at all. It's a countdown. History doesn't repeat, but it rhymes. And the rhythm is always the same.